All right, let's crack open the case file on today's explainer. You and I are going to act as financial investigators today, looking into a really fascinating structural mystery, officially titled The Problems of Indian Money Market. We're going to examine the hidden bottlenecks and unique challenges embedded deep within India's short-term financial system to figure out why, exactly, the flow of cash so often hits major roadblocks.
But before we dive into those roadblocks, let's quickly establish the scene of the crime. Just as a refresher, we are investigating the money market here. We aren't looking at long-term stocks or 10-year bonds today. This is specifically the market for lending and borrowing short-term funds. We're talking maturity periods of 1 year or less. It's often called the near money. These are highly liquid instruments designed to meet immediate, day-to-day working capital needs. Think of it like this. If the broader economy is a body, the money market is the daily heartbeat pumping liquidity exactly where it's needed right now. But as we'll see, that heartbeat has a very irregular rhythm.
And that irregular rhythm brings us right to our first massive piece of evidence, the split identity. The Indian money market is deeply dichotomous. It is essentially split right down the middle. On one side, you have the organized sector. This side plays by the rules, it's regulated by authorities, it's transparent, and it's highly integrated. But stepping outside those formal boundaries, you immediately run into the unorganized sector. This side operates largely in rural areas, almost entirely outside the purview of official regulations. So it literally means two completely different financial ecosystems are trying to operate within the exact same country, often without even talking to each other.
So let's look at the anchor of that organized sector, the Reserve Bank of India, or RBI. The sheer authority the RBI commands is massive. Nationalized way back on January 1st, 1949, it sits at the absolute apex of the banking system. It controls credit, it issues currency, and it tightly regulates all the commercial and cooperative banks operating under its umbrella. When you operate in the organized sector, the RBI is the undisputed boss ensuring stability and managing liquidity. It's a very neat, orderly side of the market, but as any good investigator knows, the neat side of town isn't usually where the wild action happens.
Building our case against that highly structured world is the wild, unorganized sector. Operating completely outside those official RBI rules are various unregulated non-bank financial intermediaries. And the sheer variety here is wild. You have chit funds, for example, which are incredibly popular in states like Kerala and Tamil Nadu. Members make regular contributions to a pool, and the funds are distributed based on mutual agreement or a draw. Then you have nidhi companies. These are mutual benefit funds that actually provide loans to their members at pretty reasonable rates. But right next door, you'll find pure loan companies. These are unregulated finance firms providing funds to small-scale industries and traders, and they often charge exceptionally high rates of interest. It's this localized, highly varied financial patchwork. Now, this dual structure creates a massive ripple effect across the entire economy, leading us straight to our next major friction point, a complete lack of uniformity in interest rates. In a smoothly functioning, unified money market, the cost of borrowing money should be pretty standard across the board, maybe just adjusting slightly for risk. Businesses and everyday people rely on that predictability to plan and grow. But because of this deep dichotomy, the market is incredibly fragmented. That fragmentation totally destroys economic predictability, because honestly, the rate you get depends entirely on who you are and where you live. Think about how this cascading system actually plays out for a borrower on the ground. If you have the right credentials, you can just walk right into a commercial bank in the organized sector and secure a strict, unified, generally fair interest rate guided by the RBI. But what if you don't? Well, you're pushed toward indigenous bankers. These guys act like banks in unbanked areas, dealing in traditional short-term credit instruments, but their rates differ widely from one local market to another. And worst of all, if you are an agricultural laborer or a small marginal farmer and have to rely on unregulated loan companies or local village moneylenders, you are completely at their mercy. You face highly exploitative rates on an incredibly uneven playing field. And compounding that uneven playing field is a persistent, baseline shortage of funds across the entire market. There simply isn't enough liquid cash to go around to meet demand. A lot of this stems from foundational economic issues, low per capita income, inadequate savings, poor banking habits, all of which keep cash immobilized outside the formal system. But there's another fascinating piece to this shortage puzzle: the complete absence of a strongly developed commercial bill market. See, a healthy money market relies heavily on a commercial bill market. It's where traders buy and sell trade invoices for quick cash, keeping liquidity moving fast. But in India, traders rarely use these bills. They heavily prefer direct cash transactions or drawing on cash credit lines.
Avoiding these commercial bills acts like a massive clog in the economic plumbing. It severely restricts the fast flow of short-term funds, drastically worsening that overall shortage. And if a baseline shortage wasn't bad enough, the timing of demand makes it even harder. Because India has such a massive agricultural sector, the money market suffers from severe seasonal fluctuations, or what we call seasonal stringency. Starting in October, the peak season kicks off. And as we move chronologically through winter and into spring, absolutely massive amounts of funds are required for harvesting, trading in agricultural product, and rural business investments. Cash is literally being pulled out of the urban financial centers and injected straight into the rural agricultural economy. This massive drain dries up urban liquidity, often causing interest rates in the major cities to spike. This intense seasonal stringency doesn't really ease up until June, creating this wild swinging pendulum the central bank has to manage every single year.
Which leads us perfectly into the systemic root of so many of these problems. The lack of financial inclusion, the unbanked margins. Despite the huge overall size of the banking sector, adequate facilities remain completely inaccessible to incredibly vulnerable groups. We are talking about weaker economic sections, low-income groups, and vast stretches of rural geography where a formal bank branch is just a pipe dream. And here is the truly vicious cycle of it all. When people are excluded from the formal system, they don't just magically stop needing money. They are forced right back into the arms of the unorganized sector, paying those exploitative interest rates to the unregulated moneylenders. It is a closed loop that actively keeps that dichotomous structure alive and well.
So, as investigators staring at all these friction points pinned up on our evidence board, a natural question arises. We live in a digital age, right? Can technology fix this split? Can modernization be the missing puzzle piece that finally unifies the Indian money market? It's the million-dollar question. Technology is supposed to democratize access. So let's examine the evidence on how tech is actually playing out in the market right now.
Well, the evidence currently shows another glaring divide. On one hand, you have an incredibly advanced metropolitan banking system. Top-tier banks in major cities are using ultra-modern, lightning-fast software. But compare that metropolitan speed to the severe delays in technological upgradation you see in smaller cooperative banks in rural branches. A smooth money market requires instantaneous communication and fund transfers across the entire network. When a huge chunk of your network is lagging behind digitally, it severely hampers the efficiency of the whole system. Technology is absolutely a prerequisite for a unified market, but currently the uneven rollout is really just another version of that split identity.
However, it is definitely not all cold cases and dead ends. Authorities have been aggressively introducing structural reforms to bridge this gap. It's a two-pronged approach. First, you have the institutions trying to reach the people. Small finance banks, or SFBs, are specifically designed to target unorganized entities, like those marginal farmers we mentioned, using high technology and low-cost operations. And payments banks are completely revolutionizing remittance and mobile payments for the unbanked. Second, you have the instruments speeding up the cash. The massive rollout of NIFT and RTGS real-time electronic payment infrastructures is vastly accelerating how money actually moves. Combine that with modern instruments like treasury bills, commercial papers, and certificates of deposit. These are sophisticated tools designed to bring a lot more volume and liquidity into the organized side of things.
So we've laid out the entire case file for you. We've seen the deep dichotomy between the organized and unorganized sectors, the wild variations in interest rates, those crazy seasonal cash crunches, the commercial bill clogs, and the ongoing struggles with tech integration. But we've also seen the really powerful new digital tools and specialized banks trying to stitch it all back together. So, we leave this final question with you. Will these ongoing reforms actually be enough to heal the split identity and unify the Indian money market once and for all? The case remains open. Thanks for investigating with us today, and we'll catch you on the next Explainer.